Welcome to Blue Giraffe Finance. Today, let's talk about why the United States will not let Bitcoin replace the US dollar as the world reserve currency. The United States treats the dollar's dominance as a core instrument of power, and institutions like the Federal Reserve, Treasury, and Congress have every incentive to defend that position against any rival monetary standard, including Bitcoin. In that context, it is unlikely they will willingly allow Bitcoin to displace the dollar or become the world's primary reserve currency, even if they choose to hold some Bitcoin as a strategic asset alongside it. The modern dollar system is not just a means of payment. It is the backbone of U.S. geopolitical and fiscal power. Since the end of the Second World War, and especially after the breakdown of Bretton Woods in the early 1970s, the dollar has been the principal reserve currency, invoicing currency for trade and funding currency for global finance. Central banks, sovereign wealth funds, corporations and banks hold dollar assets, especially U.S. treasuries, because they are liquid, deeply integrated into global markets, and backed by the full fiscal capacity of the United States government. That system gives Washington several strategic levers. The first is sanctions power. Because cross-border payments clear through dollar-based banks and systems, U.S. authorities can pressure or cut off foreign actors from a crucial part of the global financial network. The second is cheap global financing. Foreign demand for treasuries allows the U.S. government to run persistent fiscal deficits at lower interest rates than most countries could sustain. The third is macroeconomic flexibility. The Federal Reserve can expand or contract its balance sheet and adjust rates knowing that global demand for dollars provides a buffer against capital flight. A world in which Bitcoin or any private non-state asset became the primary reserve medium would erode each of these levers. If large portions of global savings shifted from dollar debt to Bitcoin, the U.S. fiscal position would become more constrained, and sanctions would be easier to evade by routing value through non-dollar, censorship-resistant networks. Seen from the vantage point of state power, Bitcoin is not just a speculative asset. It is a potential rival monetary base over which the U.S. cannot exercise direct control. To understand why U.S. authorities are unlikely to accept a rival reserve standard, it helps to revisit the end of dollar-gold convertibility in 1971. Under the Bretton Woods system established after World War II, the dollar was pegged to gold at $35 per ounce, and other major currencies pegged themselves to the dollar, making gold the ultimate anchor of the system. Over time, however, the U.S. issued more dollars and dollar claims than it had gold, while foreign central banks accumulated dollars and began to convert them into bullion. By the late 1960s and early 1970s, the United States faced the risk of a run on its gold reserves, which threatened both the dollar's status and domestic policy goals. On August 15, 1971, President Richard Nixon unilaterally suspended the convertibility of dollars into gold, closing the gold window and effectively ending the Bretton Woods system. Foreign governments could no longer redeem their dollar holdings for gold. Instead, they would hold fiat dollars backed only by the U.S. government's promises and economic capacity. When the constraints imposed by gold clashed with domestic priorities and the defense of dollar dominance, U.S. authorities chose to rewrite the rules. The gold standard was abandoned not because gold failed as a store of value, but because it limited the ability of U.S. policymakers to manage inflation, finance deficits, and maintain growth on their own terms. Gold, in other words, was prevented from functioning as a true reserve currency because it competed with the flexibility and sovereignty of U.S. fiat money. The analogy to Bitcoin is direct. Like gold, Bitcoin is finitely scarce, global, and outside direct government control. Like gold, it offers an alternative store of value that can, in principle, discipline governments by providing citizens and foreigners with an exit from depreciating fiat currencies. But history shows that when a hard anchor threatens the state's ability to manage its own liabilities, the state will move the anchor rather than surrender control. One of the least understood but most fundamental pillars of fiat currency is the state's power to tax. A modern government does not need its currency to be redeemable in gold or any other commodity. It needs it to be redeemable in freedom from tax liabilities and legal penalties. In the United States, taxes at the federal level must be paid in dollars, and legal obligations, from court fines to regulatory fees, are denominated in dollars. This creates a baseline demand for the currency that no private asset can replicate. The federal taxing power is backed by the entire legal apparatus of the state, courts, law enforcement, and the threat of penalties for non-compliance. Regardless of what citizens hold as savings, they must still obtain dollars to meet their obligations to the government, which ensures continual circulation and demand for the currency. This is why, even in countries racked by inflation, local currency often persists for tax and domestic transactions long after people begin saving or trading in alternative assets. From the perspective of U.S. authorities, allowing a non-sovereign asset like Bitcoin to become the default reserve currency would mean allowing the primary store of global savings to float outside the reach of U.S. taxation and legal jurisdiction. While capital gains on Bitcoin can be taxed when realized, the base protocol, issuance schedule, and consensus rules are not subject to congressional lawmaking or Federal Reserve policy. That asymmetry is unacceptable for a state that has built its global role on the ability to combine monetary policy, fiscal policy, and regulation into a coherent system. In practice, the United States can, and already does, tax Bitcoin transactions and holdings by treating them as property for tax purposes, tracking on-chain movements, and requiring disclosures from intermediaries. But taxation operates at the edges of the system, not at its core. The Fed can raise rates to cool dollar credit creation. It cannot increase the supply of Bitcoin to stabilize its price or absorb shocks. That lack of control means Bitcoin can never be integrated into the heart of U.S. macroeconomic management in the same way as treasuries and bank reserves. There is a broad toolkit that states use when they perceive a monetary technology as a threat rather than a complement. These tools range from outright bans to subtle forms of containment and co-optation. Historically, governments have restricted private banknotes, foreign currencies, and even gold ownership when they believed those instruments undermined monetary sovereignty or financial stability. In the context of digital assets, the U.S. and other advanced economies have already explored or implemented strict Know Your Customer, KYC, and anti-money laundering, AML, rules for exchanges and custodians, making it difficult to move large amounts of value in or out of the banking system without full transparency. Securities and commodities regulation that subjects many crypto tokens and platforms to disclosure requirements, enforcement actions, or outright delistings if they fail to meet regulatory standards. Tax reporting rules that require brokers and platforms to report digital asset transactions, reinforcing the state's visibility over flows of value. Surveillance of blockchain activity and blacklisting of addresses associated with illicit use, which can effectively cut them off from regulated markets. These tools do not control Bitcoin in the sense of altering its protocol, but they shape how easily it can scale into the mainstream economy. By regulating exchanges and gateways, governments can make Bitcoin more like a niche asset class or speculative instrument, rather than a frictionless alternative monetary standard. In a conflict between dollar policy goals and Bitcoin usage at scale, these tools can be tightened substantially. Importantly, policymakers are simultaneously exploring central bank digital currencies, CBDCs, which would provide a state-issued digital asset with the backing and flexibility of central bank money. A digital dollar could offer many of the convenience benefits of cryptocurrencies, rapid settlement, programmable features, while preserving full state control over monetary policy, compliance, and oversight. In that world, Bitcoin is more likely to be framed as digital gold or a speculative reserve asset at the periphery, not the core instrument through which taxes are paid and policy is transmitted. Recent U.S. policy discussions illustrate this dynamic of containment and co-optation rather than surrender. The Trump administration's move to establish a strategic Bitcoin reserve is a prime example. Under the executive order, the government would pool Bitcoin already seized through criminal and civil forfeiture into a permanent reserve asset, with agencies instructed to transfer their holdings to a central reserve. Legislative proposals like the Bitcoin Act of 2025 frame this accumulation as a way to strengthen, not replace, the dollar's global role. Supporters argue that holding Bitcoin could provide a hedge against economic uncertainty and monetary instability, diversifying national reserves and protecting the long-term purchasing power of public assets. They emphasize that Bitcoin's finite supply and decentralized nature make it a useful complement to traditional reserves like gold and foreign currency, particularly in a world of mounting debt and potential inflationary pressures. At the same time, they explicitly state that such a reserve is meant to strengthen the position of the United States dollar in the global financial system, not undermine it. It shows that U.S. elites are willing to integrate Bitcoin as long as it serves the interests of the dollar system. By seizing and stockpiling confiscated Bitcoin, the government simultaneously exerts market influence and aligns Bitcoin policy with broader strategic goals. The very act of creating a state-managed Bitcoin reserve demonstrates that U.S. policymakers see Bitcoin as something to be harnessed, not as a new monetary sovereign to which they owe allegiance. Analysts from rating agencies and think tanks have described the symbolic power of the strategic Bitcoin reserve, noting that it formally recognizes Bitcoin as a reserve asset while leaving the core fiat framework untouched. Commentators have pointed out that substantial state holdings could even enable governments to influence crypto markets directly, much as they intervene in gold or foreign exchange markets through official reserves. Far from ceding the field, the U.S. is positioning itself as the largest known state holder of Bitcoin, with estimated holdings around 200,000 BTC. Even if the United States did nothing, Bitcoin would face structural hurdles in replacing the dollar as the world's primary reserve currency. Reserve assets must not only hold value over time, they must also facilitate large-scale, low-friction, and politically acceptable transactions between sovereigns, banks, and corporations. On each of these dimensions, Bitcoin runs into obstacles that U.S. policymakers can amplify or exploit. First, volatility. Bitcoin's price has swung through multiple boom and bust cycles, with drawdowns of more than 70% from peak to trough. While volatility has trended lower as markets mature, it remains far higher than major fiat currencies or gold, making it a challenging asset for central banks that must manage liquidity and capital buffers. A reserve currency must provide stability in crises, not add an extra layer of speculative risk. Second, governance and lender of last resort functions. The Federal Reserve can act as a lender of last resort by expanding its balance sheet, backstopping markets, and providing dollar liquidity in emergencies. Bitcoin, by design, has no central issuer and no institution mandated to supply liquidity in times of stress. That feature is attractive to those who fear discretionary central bank power. but it is a bug for institutions tasked with stabilizing banking systems and payment networks. Third, political acceptability. Reserve currencies are embedded in alliances, trade relationships, and strategic bargains. The dollar's dominance is underpinned not only by U.S. economic size, but also by security guarantees, trade flows, and institutional depth. For Bitcoin to displace the dollar, major states would have to accept a regime in which no single government could shape monetary conditions, a scenario that runs against the grain of how political elites think about sovereignty. U.S. authorities are not passive observers of this process. They are active players. By tightening or loosening regulation, by signaling support or hostility, by taxing and surveilling flows of value, they can influence where institutional capital goes. So far, when monetary conditions have tightened, such as during Federal Reserve balance sheet reductions, Bitcoin has struggled, while traditional safe havens like gold have held up better. This pattern reinforces the perception among officials and risk managers that Bitcoin is, at best, a high beta asset rather than a foundational reserve instrument. The central thread tying together 1971, the taxing power, and today's digital strategies is the state's refusal to voluntarily surrender monetary sovereignty. The Nixon shock showed that when an external standard, gold, threatened to constrain domestic policy, the U.S. altered the standard rather than adjust its fiscal and monetary trajectory. The rise of Bitcoin presents a similar challenge in digital form. A global, borderless asset with rules that are exceedingly hard for any single government to change. Yet in practice, states do not need to break Bitcoin to neutralize its threat as a reserve currency. They can keep official reserves and key financial contracts denominated in dollars, maintain tax liabilities, legal judgments, and regulatory fees payable only in dollars, control banks and payment companies that serve as bridges between fiat and crypto, accumulate strategic holdings of Bitcoin while treating it as a peripheral hedge, not a core unit of account. In such a world, Bitcoin may coexist with the dollar, held as a speculative asset, a digital gold, or a hedge against worst-case scenarios. But it will not be allowed to freely evolve into the primary world reserve currency. When push comes to shove, the same logic that led the U.S. to sever the dollar's tie to gold in 1971 will drive it to use taxation, regulation, and financial muscle to ensure that the dollar, not Bitcoin, remains at the center of global finance. Thanks for watching. For more great videos, please subscribe to the Blue Giraffe Finance YouTube channel.